Hey everyone, it's Imran from Options Insight and welcome back. Happy New Year. It's a new year and what has this market been doing? Before we jump in, please like, subscribe, comment to this video. So that really helps us with the algorithm and gets this content in front of more people. So we thought it was going to be quiet. We thought there was a good probability that the S&P was going to be stuck, especially with the positioning that we highlighted with that big pin on the 30th of December. And that kind of seemed to play out. I'd been on Twitter a few times over the last couple of weeks, just saying how this pin is unbelievable, how we just can't break away from it. Anytime we got like a 1.5% away from it, we then got dragged straight back down again. Now that thing expired last Friday on the 30th. And I do think now we're likely to be a bit more free to move around because that's a significant amount of gamma that has expired on the S&P, order of magnitude of about $4 to $5 billion, which is not small. So we may well see, and then also fresh flows are going to come back, obviously, as people get back to their desks and decide what they want to do with this year and what sort of positions they want to put on early this year. We've also got earnings season coming up middle of January as well, so that may well drive some flows and some positioning. If we look at Europe, which was open obviously yesterday, US markets weren't, but Europe was. So I've highlighted that in yellow on the screen. So we saw a decent move out of the gates in Europe, up at 1.5%, Euro Stoxx and DAX. And that's actually followed on a bit. That was up another 1% earlier this morning, but it has started to fade. S&P futures had followed suit as well. They got up to around 38.80, have started to fade back down again though. So bit of noise there, bit of people coming back, thinking, okay, it's a new year. Let's put some money back to work. And are we going to have our customary little rally as we often get in January? But for now, I would say, don't get puffed into the noise too much. Let the dust settle. Let the market kind of find its equilibrium over the course of this week. And we have got a few data points coming out as well this week. So I wouldn't be in a rush to put on new trades yet and kind of be patient. Waiting for entry levels kind of makes the most sense right now. If we look at what Asia's been doing as well, whilst that had, been pulling back a little bit, fears there, given that COVID infections were soaring. So even though they're not in lockdown, because of the mass contagion that we are seeing and the spread now that they are kind of trying to reopen, that has obviously impacted mobility and things like that. So you were expecting kind of economic data out of China to be quite bad still as they work their way through those mass infections. Now, we did see some data, PMIs overnight from China. They weren't actually as bad as feared. So that's why Hong Kong's up about 2% overnight. Looking at commodities, they had a pretty strong end to the year, showed some relative strength, apart from nat gas, which has been obliterated. We had been saying in our last few notes of last year that we were worried about natural gas breaking this $5 level. And if it had a conclusive break below there, then it was going to go down quite hard. And that has materialized. And we're now looking at nat gas in the US down at about $4. So that's a quick 20% drop from that technical break that we were fearful of. Gold, on the other hand, has fared pretty well. That's been eking out small sort of gains throughout that quiet period. And this morning had a little break higher, got as high as around 1850. So that's a pretty conclusive break. The level that we were looking at was 1810 and then 1835. That's popped its head now above that. And so that kind of opens up the fresh target at 1880, which is a bit more meaningful in terms of resistance. If it gets above there, then who knows where gold wants to go. But definitely seems to be starting the year on a stronger footing as people are getting ready for potentially a weaker dollar over the course of the year and an eventual pivot from the Fed. Both of those things in theory should be supported for gold. Looking at volatility, it had been quiet, obviously, over the quiet period. Not a lot going on, really. Started to pick up a little bit towards the end of last week as people, looking for more, anticipating a bit more movement as the new year begins. So that's what vol tends to do. It gets sold into the holiday period. And as we're coming out of the holiday period, it tends to catch a bit of a bid at the back end of that. European vols, obviously, European option markets were open yesterday. We did see a decent bid coming in for DAX and Euro Stoxx vol, 3/4 of a vol to half a vol up there. Chinese vols have obviously also been quite well bid, up 4 vols on the week. So that was a decent move in FXI vol last week. And commodity vols in general have been firming up. Gold miners, silver, oil, copper, all of them putting in decent weekly gains in vol. all except Nat Gas, which is down nearly 10 vols again. So Nat Gas definitely having this correlation between vol and spot, such that when spot goes down, vol goes down, and when spot goes up, vol goes up. And it's continuing to do that, even though we've had a slide of around 20%, pretty sharpish. So realized volatility, is going to pick, doesn't include the 10% move that we've just seen. So that 72 is a bit understated. So you'll see that get revised tomorrow when that data comes into the data set as the ETFs open back up again. And then skew remaining pretty low, single digit percentiles or lower percentiles for most of the US and European indices. We do think implied skew might find some buyers as people put fresh money to work and then maybe buy protection alongside that. But realized skew from our metrics has been terrible. So we do think that volatility traders will need to see more convincing evidence that implied vol is going to work to the downside before they want to go and own a load of puts, basically, right? So I wouldn't expect these skews to catch a real bid until we see some real evidence of vol working on the way down. And the market not only needs to go down first, it needs to go down in a decent realized manner, and it implies need to react to that, right? So we're a ways off that right now. Okay, moving on. If we look at the week ahead, we've got obviously PMIs in Europe, China, and the US coming out to give us a handle on where the economic activity lies right now. Obviously, everyone's expecting that we are going to see weaker economic data throughout the course of the year as we head into a recession. Chinese data, like I said, was expected to be pretty bad. If you look at the mobility data coming out of China, and it does seem that the infections, the widespread contagion is having a similar impact to what lockdowns would have had, right? So clearly that data was kind of rock bottom when we were in lockdown mode, and looking at it there, you can see road congestion, subway trips. These are the two lines that we're looking at, and they're both heading back down towards levels that they were at when we were in lockdown mode. So now clearly they're going to come out of that at some point, but the question is, what's the death toll going to be? And what is the impact that that's going to have in general economic activity for China? And also China is a big, obviously, exporter. So what impact is that going to have? Remains to be seen. But, a lot of people looking at the Chinese equity market, a lot of people are still trying to look past that and are quite bullish, thinking that China are reopening fully. This is something that we've all had to deal with, a rise in infections. And then when they come out of that, then it's game on, basically. And that's slightly what is giving a bit of a bid to the commodity market, I would think, as well, and crude oil. What else this week? FOMC minutes on Wednesday, non-farm payrolls on Friday. So these are going to be your key data points. Outside that, give us clues on the labor market and the Fed's reaction function. Markets are already obviously pricing in a more aggressive Fed pivot than the Fed are willing to admit to right now, or what they've guided towards. We'll see how that plays out. But obviously, you've got CPI next week as well, I believe, on Thursday. That's going to be closely watched because that number has become the main event for markets. And we'll see if the downtrend in inflation that we've seen lately is strong enough to allow the Fed to soften their stance, or whether we're still going to continue to see rate hikes in February and beyond. And the market's still pricing in, I think, 25 basis points for February. That's also what we believe is quite likely. We think it's unlikely that even if we get softer inflation numbers, they're just suddenly going to stop, right, given the guidance that they've given. And then the other chart I've got here is growth stocks, showing the underperformance of growth stocks last year, and just basically talking about how Tesla has been in the spotlight recently, and sentiment got extremely bearish on Tesla, where it touched just below $100. We do see room for a bounce. Unit sales data out due this week from Tesla. See what those numbers look like relative to expectations. But the stock was very beaten up. It already started to have a little bit of a bounce back above 120. But we do think there's a chance into the earnings or post earnings on the 25th of Jan, Tesla could pop its head back towards 150. But we think it's a rental. If you are brave enough to dip your toes into Tesla and buy that stock to play the kind of contrarian sentiment trade, like I say, I think it's a rental. It's not something you want to buy and hold. But we did think it was getting a bit extreme as well. And so there's some very smart traders out there who I like to follow, like Brent Donnelly over at Spectra Markets. He put that on as a contrarian trade as well, as it did look like it was a bit overdone. But like I say, it's already had a bounce to 120. So 100 to 120 is a 20% bounce. Is that enough? That may well be enough. So be careful on that one, and don't get married to that position if you are getting involved in that stock. Okay, but in general, we are still pretty bearish risk assets for this year. We do think people might put fresh money to work. Earnings season, depending on how stocks do relative to expectations, there might be a little pop in things like banks and stuff like that. But like we say, we're not expecting great things for the first quarter in terms of equities. We would rather own bonds, to be honest. And that's kind of how we're looking to position the book: short equities and long bonds. And that's how our overlay portfolio is kind of biased for now. Couple of themes we're looking at, obviously positioning going into 2023. The dollar short is being driven by euro positioning, which looks pretty extreme. It's at nearly a 2-year high right now. So we think that's one to keep a close eye on. We think the euro might have got a bit ahead of itself. It's coming off 1% today, like I said, but that's a trade where we like things like risk reversals, bearish risk reversals, or just long puts if the vol gets cheap enough as a way to play that, and maybe probably go 6 months out and give yourself a bit of time for that to play out. Obviously, the inflation in Europe tends to lag the US by about 6 months. So you don't want to go too short dated with your euro bearish bets. You want to kind of let that inflation peak in Europe as well. So you'd go probably June as a minimum expiry for that type of trade, I reckon, right now. And then commodities, as we said, commodities did catch a bit of a bid. It definitely seems like an asset allocation that investors will need still this year, even if inflation does pull back from the highs like we're seeing. Just structurally, there's a lot of reasons to own commodities in the portfolio. Underinvestment, we still expect demand to come back online from China. We think the green transition is going to keep a bit of a structural bid and a tightness in that market for things like copper, for that whole electrification story. So buying dips in commodities, if you get them over the course of this year as fears for global recession kick in, be a pretty smart way to do it, as you don't necessarily need to pile in right here right now. But we definitely did see some hedge funds load up on some commodities in the last few weeks of last year. And the last slide, really talking about, will the dollar shine in this year? Massive flows from central banks to buy gold last year. Obviously, you had the Ukraine invasion from Russia. You had their dollar reserves getting confiscated. And therefore, a lot of foreign central banks would have seen that and realized that they need to diversify away from dollars. And that's basically what was going on throughout the course of last year. And I think that explains a lot of why gold outperformed. You look at absolute levels, gold was flat on the year, but equities are down 20%. Bonds were down 30%. Look at gold in other currencies, that was actually up. And so, not a bad place to allocate some capital in terms of to preserve that capital. And then finally, the kind of decoupling of gold and real yields was also an interesting thing that we observed, where you can see the red line here is real yields inverted, and gold. They have a pretty strong relationship because the real yields is like the opportunity cost of holding gold, because gold doesn't give you a yield. And that kind of decoupled last year, right? So definitely some positive price action towards the back end as well of last year for gold, and it's come out of the gates looking quite strong as well. So is it going to be gold's year? Certainly feels that it might be. Okay. All right, it was a bit of a long one, but I haven't seen you for a couple of weeks, so hopefully you found it all useful and it makes sense. And I'll catch you guys tomorrow.